All right, so here we are in the After Hours show, and Shalin, you're back online here. And well, first of all, thanks for a great interview. Now, you're out in Florida right now, are you not? Is that where your office is located?
Yes, yeah, in the Fort Lauderdale area.
Nice. How's the weather out there? I'm going to be actually heading there. I got a little show in Orlando in a couple of weeks, and things sunny out there.
Oh yeah, nice and hot.
Okay, well, we have to ask you the question. I saw on your Twitter that you had a great story of when you came to Canada to visit. Now, were you visiting Kieran? Was that right?
Actually, believe it or not, almost all of my family is located in Canada.
Oh, wow.
Okay.
Okay. You were the
Yeah,
smart. You
so
were the
Yeah,
smart
you're
one
the
that chose
smart one.
Florida.
Yeah.
That chose Florida.
I don't know. Sometimes I question that. I question that. But yeah, I've pretty much most of my family's in Calgary,
Okay.
and I've got some small. I've got a cousin in Toronto as well.
Right.
But I spent almost every summer in Calgary growing up.
Okay.
So because my parents would just basically they couldn't handle me, so they would just dump me in Canada.
People
And
don't
so I
real.
pretty much know
Yeah.
what
People don't realize that
I
Calgary
pretty.
it's actually snows in the summer, and we're not kidding about that. And
Oh,
you were there. I'm sure you experienced
oh yeah.
it. Uh,
Oh yeah, I've been in the winter too, by the way. So
yeah,
I mean, I know -40.
Still, by the
I've
way,
been there.
it's a beautiful city.
it is.
I absolutely love it.
Yeah.
But yes,
But
it does
anyways, you
snow in
had a
this.
great story. You got to tell the story because I saw it on Twitter. You were ended up
Yeah,
hitchhiking, or I don't know. You got to give me the whole story because it was a great story, and I'm
yeah,
sure our
man.
listeners would love to hear it.
It was totally crazy. So yeah, here I am. Okay, so I go to Canada as I do every year practically, and see my family, and they're gonna have a party. So we usually have like a kind of a cowboy barbecue party at their house. My cousin has a phenomenal house, and our friend Kieran is he's actually located in Idaho,
Right.
and so I said, this is probably the closest I'm going to be to you. We're about 7 hours apart. So, we ought to meet. I said, okay, yeah, that's great. And so, we pick a place like in the middle of BC um, to meet. And so, I do the usual. Right? I rent a car, and I'm driving the car. And anybody who's driven in Alberta knows the moment you get out of Calgary, there's pretty much there's nothing there. And basically, about 120 kilometers in of a 240-kilometer drive, my car starts shaking. I'm like, this is really weird, man. And then, like, basically 3 minutes later, it starts slowing down, and I go to the shoulder of the road, and I'm like, oh my god, it's about 9:30 in the morning. I'm supposed to meet him like at 11:30 for lunch,
Where were you meeting, by the way?
and
Where in BC?
Fernie,
Fernie. Okay, fair enough. Good skiing town. Okay, continue.
yeah.
Yep.
So anybody who knows Calgary to Fernie, that's like a 4 hour drive, okay?
Uh,
And
Not
you
for
know, and it
Calgarians.
and
They do it a little
it.
faster than that. But anyways, okay, go
And so yeah, my car breaks down, and I don't know, I don't know where it was. The whole story is on Twitter. I have a lot of screenshots, but basically I have to make the audible, right? I have no phone service. I'm madly texting Kieran, like, can we cancel? And it's not going to him because I have no phone service in the
right.
middle, literally in the middle of nowhere. Basically, 30 minutes into it, I make the audible. I can't get a hold of anybody. I don't know what to do. Practically, I'm sweating. Um,
Yeah.
and I leave the keys in the car. I put the emergency lights on, the flashers on, and I just basically I stick my thumb out, man. And, and believe it or not, like the first person who kind of saw me was basically picked me up. Says, where are you going? I said, man, I need to get to Fernie. And he's like, well, I'm not going to Fernie, but I'm going to Crow's Nest Pass, and I can drop you off there. And that was about a 60-kilometer sort of drive. And so I said, okay, fine. I'm just getting me to my direction, and we'll go. And it was great. But then I'm in Crow's Nest Pass, and I'm still about 45 minutes or so out of Fernie, and I have to figure out how to get to Fernie. So I'm at a gas station, and I just basically start going up to everybody. Hey, are you going to Fernie? Are you going to Fernie? And people are looking at me really weird. I mean, who is this guy?
Yeah.
But you know what? Like the third guy who I spoke to said, I'm going to Fernie. Happy to take you. And super nice guy, great conversation. Dropped me off right in the middle of Fernie. And I actually made my meeting and my lunch meeting, and I got to finally meet our friend, in the flesh. But there was a problem, guys.
What's that?
How do I get home? So at least at this point, I have cell service, and I basically text my cousin. I said, what do I do? And so they're calling around trying to figure it out. I'm like, I'll even fly if I have to, but there's no airport or anything like that. Yeah. So I ultimately end up taking a taxi. It was by far the most expensive taxi ride I've ever taken. But
should have used Uber.
And I should have. There's no Uber in Fernie, believe it or not.
How much was the cab ride?
It was $602.
What?
Yeah, but
that's Canadian dollars. That's nothing
like,
for you.
It's like
Canadian dollars.
That's like $132 or something like that.
142 American dollars or something like that. But yeah, he was, and this guy was like totally happy.
Yeah.
But it was a trip. It was a trip, guys, because I'm sitting in the front seat with the taxi driver, and he's telling me his whole life story and about how Fred's a horrible coworker. I don't know who that Fred is. It's like, but you just have to kind of nod and
yeah.
But he was super happy, but the beautiful part about it was that I put in a claim with the car rental company and actually got a reimbursement. So the whole thing was taken care of.
There we go. That's a great story. The only part that I'm going to quibble about is the fact that you said between Calgary and Fernie was in the middle of nowhere. As a Canadian, I can attest that that's actually pretty populated for out west. That is not the middle of nowhere. Like I thought, like when I saw it, I was like, "Oh God, he's going to be way up north." Like, hey, like he could be north of Edmonton and like near Grand Prairie or something. And then like you're telling me you're at Fernie, and like this is the middle of nowhere. So that's my only quibble about the story, but otherwise it's a great story. Okay, let's talk some markets. Let's talk some markets. You spoke a little bit about the bond market. You talked about the stock market. Why don't you talk about, we were talking a little bit before we did the show about how you use different ETFs. And one of the things that you view as a strategic advantage is that you're open to using different ETFs in different ways. Why don't you give us some examples of the different kind of products that you might put in in your portfolios versus a more traditional manager?
Yeah, sure. Well, the kind of the conundrum that we've been trying to figure out is how most tactical models, as you guys know, will try to use fixed income exposure as some form of a risk management asset class, right? So basically, I'm not too thrilled about equity risk. Let me just throw it into some bonds. Problem is that bonds are very risky. Even if yields are going to go lower, the path is not going to be straight, and they're extremely volatile now because the duration of some of these instruments is just significantly more than in the past. Right. And so and in some cases when you're at the zero bound, like why would you buy a German Bund?
Because it's going to go more negative, don't you know?
Yeah.
It's
the convexity.
Exactly. That makes that as an allocator, that makes no sense to me whatsoever. So that's where we're on the same page. That being said, if I were concerned about equity risk in general, are there surrogate trades that could be created that kind of act like bonds but are not bonds? So they have much better what we call convexity, and so there are some interesting, products out there. For instance, one of the products that we find pretty interesting is the anti-beta ETF,
What's the symbol for
which
that? I don't know
essentially
that.
BTAL.
BTAL.
Giving them a free plug.
Free plug. So it's the
but
anti-beta. Why don't you tell us about it? What does it do?
yeah, basically this is an ETF that will buy a basket of the lowest beta stocks and short a basket of the highest beta stocks, simplistically. And the whole kind of thing about that is in a market event, in a market dislocation event, the low beta stocks should outperform the high beta stocks, right? You have an equal amount of each on the long and the short side.
Until the
And so the
correlation of
nice
all
thing about
assets
it,
becomes one. Anyway, sorry. My,
even believe no, but no, it's a good point. It's a good point. So the correlation could be one, but the beta could be different,
yeah.
right? So because the volatility profiles of the assets are different. So what you should still end up getting, you probably will lose on both sides of the both sides of the books will decline, but one will decline more than the other. And so what you find with that product, and we also complement that with some S&P sectors, like the industrials versus staples, for instance. Uh, what you find is that they do appreciate just like bonds would. And you can just go onto a Bloomberg or overlay a chart, fixed income, and it looks very, very similar. Now, likewise, you're probably also going to lose money if fixed income yields rise, right? Because that should benefit more cyclical or higher beta sectors. But what you also find, and this is also, Kevin, probably music to your ears, but what you also find is that the downside properties of this trade are significantly better than just a straight fixed income trade. So if you're kind of trying to produce a palatable return to investors, because investors don't want volatility, we all know that.
Right.
This is one way of doing it. And so we're always kind of constantly figuring out, ways to adapt to this environment, which is just changing very, very rapidly and is meaningfully different because of what's going on in bonds in general.
So do you think that like I'm intrigued by that trade because one of the things I worry about is that this kind of 2-decade long negative correlation between stocks and bonds is going to break down. And maybe I'm wrong. Maybe it's 3 decades. And if it does, I worry that a lot of people are going to get hurt. Like I actually think that's one of the potentials for the biggest problems going forward. So are you worried about that same thing? And if so, would you argue that this is a better complement to stocks than bonds? Like, is that what you're kind of like in essence saying?
Well, in our context, it's a way of taking advantage of a risk off where bonds are no longer providing the same sort of returns mathematically as they might have in the past. So that's the first thing. And then the second thing is because bonds are not necessarily providing the same sort of upside in the past, it naturally means that the downside, upside sort of ratio is much different now and obviously much favored, to the downside.
Isn't that just a
And
quant's way
so
of saying yes?
so the answer is yes, but there's also something else I think that investors should and macro guys should probably take heed of. That to your point, actually, one of the things that we've done as well. So we're constantly tweaking our models based on kind of our view of the world. Is we think volatility trading is probably going to have a new life to it. Long volatility trading. So if in the world that you're describing, which I also that's what keeps me up at night as well. Um, Trading volatility on the long side is probably going to be an attribute that's very important to portfolios because that also can act as a surrogate to the sort of losses, the lost return that fixed income could generate, for you in the past. You didn't need to be long volatility in '08 because TLT would rally 20% in a matter of weeks. It could happen again with TLT, perhaps. But the lower bond yields go, unlikely, and it certainly won't happen again with German bunds,
Right.
right?
Oh my
Mathematically, almost
God! Well,
impossible
yeah,
now.
until they're -1.5, and then
Oh,
when
shucks,
they're
Patrick.
-2. I mean,
Yeah.
listen, if U.S. rates can go -4, I mean, we can go much further in Germany, right?
Yeah. So,
Yeah,
but how
what
do
an
you
upside down
do?
world.
So I personally, when I want to get long vol, I just end up buying a bunch of options and delta hedging it. What do you do to get long vol in instruments that like, I don't love buying equity vol. I'd rather own fixed income or FX vol. So how do you kind of implement that trade?
So because we run a diversified portfolio, we do a little bit less in the option space, and we're generally trading delta one. So for us to go long vol, we'll trade the VIX futures.
Okay.
And so that allows us to kind of figure out how we want to be positioned in the curve. Do we want to be a little bit more longer dated or shorter dated? That's based on the models and the view. As far as fixed income vol, we trade. So again, we have a whole menu of fixed income and credit ETFs that we'll trade based on the regime. So if we thought, for instance, that rates would rise, we might want to park our assets a little bit more in floating rate debt. And so we just like that sort of exposure because we're not options experts. We will, trade options here and there, but it's never going to be a large, part of our P&L.
Okay. So I also see in your kind of slide that you mentioned like you even trade bank loans and
Mm-hmm.
what is this business development companies? What is that? I don't even know what that part of the credit is. How do you trade? Is there an ETF for that?
Yeah, there is. Or you could trade. You could just buy a basket of them as well.
So
We
what's
just tried. We like. What's a business development company?
or no? I know what's the business development ETF.
We trade the BDCS and the BDCL.
Okay, let me just look at these.
So the BDCL is a leveraged BDC ETN, but it's not leveraged in the same way that we think about some of the more traditional ETFs. This leverage factor is actually reset on a monthly basis.
Okay.
So what happens is that you don't get the same decay. You don't get actually any decay. The sort of decay that you see in the daily products like the VIX, which is which obviously very detrimental to anybody who wants to be long. So the reason we find that very interesting is because once again, like so here's how we would create an algorithm. For instance, if this kind of comes from the fact that I used to invest a lot in the CLO market,
Right.
and what I realized was that hey, wait a second, it's really a lot of things are the same risk. So if you're buying a CLO, which is a pool of loans, effectively, just generically speaking, it's really not terribly dissimilar at the face of it than a BDC, which is also a pool of loans. And so if you had a really good model to trade CLOs on a macro basis or loans on a macro basis, because you said, okay, well, GDP is this, or leverage is this, you have all these different factors. You should be able to transplant those same factors for BDCs because it's a pool of loans, right? So if you have 1,000 pool of loans on your left hand and 1,000 pool loans on your right hand, statistics from a probability standpoint, the same factor should drive them. And so what we like about BDCs is the extra juice that we can get because they're yielding 3 or 4% more than a traditional loan in that wrapper. And what happens as well, as you guys know, with BDCs and a lot of these instruments, is they can get dislocated. So they could be trading significantly below their net asset value, and it creates tremendous opportunities.
Right. Speaking of kind of things getting dislocated, you mentioned early in the first part of the interview that you thought private assets were in a bubble. Why don't you
Oh
tell
yeah.
us a little bit about what you're seeing there and what your thoughts are?
Well, I mean, you guys heard of this company called WeWork? So, I mean, so part of my background is, in addition to, trading this quant book, when I ran a family office, I did a lot of private investing, and I would underwrite deals, and so in 2010 and 11, and we were just shooting fish in a barrel, man. I mean, I could easily underwrite a deal for 20% with a high confidence level, and I did a number of those deals. But what started happening 2014, I started getting deal flow, and I'm having to lower my threshold, right, to 13 or 14%. I'll still do it, right? But 13 or 14% is not 20%. Well, then I'm in 2017, and now it's like 8%. So literally, I'm taking a set of scenarios, exact same set of scenarios I'm doing before, and I'm underwriting deals for 8%. And in some cases, my base case was in the low single digits. And if you start thinking about it from an allocator standpoint, um, you know, so if you have to pay fees, say you're paying 2 and 20 to a private equity manager, uh, your whole return is eroded. And for me, that was like the ding 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 moment where I realized that, hey, wait a second, this is really just equity risk now. It could be even worse than equity risk because it's illiquid, and you're probably better off being more tactical in the equity market, waiting for that dislocation, as opposed to kind of playing a buy and hold in private equity. So that was kind of the aha moment. And then, the other catalyst for me, probably the aha moment, was when I was offered Uber at $65 billion in 2016,
Right.
at 30 times sales or something like that. At least it might have been more. And every family office, every investor was clamoring for that deal. And just having seen this before, I said, this has to be it. And so what I think we're seeing right now, frankly, is the 2000 and 2001 moment. The problem is, and this is what makes it really crazy, is that a lot of it is still illiquid. Like, at least in '99, we all saw ourselves lose money, right? Like,
Right.
right in front of us. That was, it sucked, but we lost money.
Yeah.
We could see it. Now it's like you don't even know what your mark is, right? You don't even know that you're down 80% potentially.
Right.
And so people just kind of go on with their lives, I guess. And I don't know if it's good or bad, but there's a lot of losses out there, which I
Yeah.
don't think a lot of people realize.
But I guess though the thing about 2000 that was different, it was spread over into retail, and this will be different in that it's in the hands of family offices, high net worth individuals, pension funds. Like it really isn't is kind of spread throughout the economy.
Well, it's probably in a way it's sad. I think that the retail is no longer involved. I think retail customer has bigger worries on their mind these days than the markets, which
Well,
is just a
Well,
sad
I
testimony
think
of
sad
it's
that
not
they didn't
sad.
make
where we
money on the
stand,
way
right?
up, but I don't think
Yeah, but
anyone's going to be sad
Yeah.
that they didn't lose on the way down.
No,
right. Like
no. I mean, look. I mean, the somebody's going to lose, right? It might be spread across a lot of different people, or it could be, instead of the retail investor owning it, it might be in their pension fund.
Yeah.
well, that's true. Yeah.
So, right. So maybe it not being concentrated in the hands of a few could be a good thing. But from a macro standpoint, when you have this much money that's been chasing these deals at such ridiculous valuations, there will be losses for the overall economy. In fact, mathematically, they'll be worse than the previous cycle.
Right.
As a percentage or just in absolute dollar terms?
Um, as a from an absolute dollar term,
Yeah, just because the economy's bigger.
right?
Right. So you mentioned, you said that you think that people don't realize the losses that their portfolios are like have experienced already because nobody's marking it. So does a kind of shock where that moment when Goldman Sachs and Bear Stearns and everybody remarked their CDX exposure, and there was kind of an awakening in the markets. Does that happen on the private side, and does it kind of spread out into the public markets, you think?
In a weird way, the public markets are almost a safe haven, because only, and this is where I do grapple with this as well, um, because only the highest quality companies have been able to go on to the public market. So all the crap is in the private markets, and there's been a huge hurdle to be in the public markets. Likewise, one of the things that we realized, some work that we had done a couple of years ago, was that across a swath of assets, and there's some guys on Twitter, for instance, have talked about this as well. You actually had better valuations in public assets than you had in private assets, which is weird, right?
Yeah.
And so I think that it's just basically probably going to be a lot different, which is more of an L shape, kind of a deflation, if you will, of just, people are just going to start realizing they're not getting any distributions. And so therefore they can't commit any more capital to these deals. The '08, that, it's very unlikely that the '08 sort of scenario is at play here, because everybody's optimized their, the way that they do things for that sort of environment. But I think we're really just stuck in an environment of really low, crappy returns, which is, could be frankly even worse, because at least with an '08, it just got done over with.
Right. Well, it was a pleasure having you on, chatting on that kind of cheery note. We'll leave it.
It was
It's probably
great to
actually,
chat.
though, it's a very fitting note given the difficulty in the market these days. Thank you very much for being on. Why don't you tell people again where they can find you and kind of give people your coordinates?
Sure. Bodhitree CIO, BODHITREE CIO. Website, btam.co, and happy to, you can email me from there. And I really appreciate you guys having me on.
Oh, thank you for being on. It's great to have you, and have yourself a great time out there.
Yeah, and make sure your car doesn't break down in the middle of nowhere, Canada again.
You know what? This sort of experience where, I'm going to be able to tell my my grandkids about that. It was phenomenal. And by the way, just as an aside, gave me a real. It's one of those things where you get a real insight into Canadians, and you guys are the best.
Well, it's
Thanks.
too kind. They were actually just looking for some beers from you. That's the truth of the matter. Anyway, thanks for being on. It was a pleasure having you.
Thank you.
Have a good one. Bye-bye.